Hello everyone. Hello everyone. Great to see all of you guys once again. Thank you for joining us tonight. It has been a while since we last gathered on Zoom for a webinar. Right, but I hope you guys have been following us on Telegram because we have been posting on Telegram pretty regularly about our thoughts and our views on the markets updates, right? So while we wait for more people to come on Zoom, I'll just flash the usual disclaimer first, okay? Please take note that what I'm going to share with you guys tonight, they are not financial advice and they are just my personal opinion. And this entire sharing is for educational purposes. So before you make any investment decisions, please do your own due diligence and your research, okay? So how are you guys feeling about the US stock markets right now? Okay, I want to do a poll to let me know how you guys are feeling right now. So what I'm going to do is I'm going to launch a poll on Zoom and you just let me know your opinion, whether you're feeling bullish or whether you are feeling bearish about the US stock markets right now. Okay, let me know about your opinion in the poll. Are you guys bullish or are you guys bearish about the US stock markets right now? Okay, let me end this poll and share the results with you guys. So interestingly, I think it's about half. Somewhere, on 56% is more bullish, but I would say it's half about there. Okay. Actually, earlier on, we also did a poll before on investing notes, and these were the results, right? We did two polls. The first poll that we did was sometime in June, and at that time, we can see that actually 50% of the respondents, they were bearish, while 50% of them, they were feeling somewhat neutral. Probably they don't know whether to feel bullish or bearish. Then 1 month later, we did the same poll again in July, and this time around, 66% were bearish, right? The 33 plus 33, you get 66% of them, they were bearish, right? And there was this increase in percentage for the bearish side. Probably it might have been due to some of them being affected by the 9.1% inflation rate that was reported in that month in July. Well, but the interesting thing is that the stock markets tend to move in the opposite direction as the majority. Meaning to say, when the overall broad sentiments are overly pessimistic, stock markets tend to rebound. And when the sentiments are overly optimistic, that's usually the peak where the stock markets start to come down. Right. So for our case today, I think we are somewhat in the middle. Cannot really take a stand. Right. Half of us are feeling bearish, half of us are feeling bullish. Okay, so my agenda for this Zoom session tonight, okay, is to mainly focus on a market update on the US markets, and then I'll move on to talk about Singapore markets. Now, so for those of us who are joining us for the first time tonight, today's session is part of our regular short sharing sessions, right? Usually for such short sessions, I'll try to cap it under about 45 minutes or so, right? Short and sweet, so that you guys can have a good rest after a long day of work on a Thursday evening. Okay, then along the way, if you have any questions, you can feel free to type in the Q&A box, right? And please do interact with me as well. If I ask you a question, you can reply me in the chat box so that it doesn't feel like I'm talking to a laptop, to a screen in front of me. Okay, so if you guys are ready, can you type a yes? Okay, if you guys are ready and you can hear me loud and clear, can you type a yes in the chat box so that I know everything is good? Type a yes in the chat box if you guys are ready and you can hear me loud and clear. Okay. Some of you guys send it to me only. Okay, you can send it to everyone. Okay, so okay, I see yes. Okay, before I begin, allow me to very quickly share with you guys the next upcoming workshop that I'll be holding in September. It is on how to build passive income with Singapore REITs. Okay, so this workshop, we will be focusing on Singapore REITs itself, how you can actually construct a portfolio of Singapore REITs. If you're interested to find out more details, you can scan the QR code on this screen over here. So for those of you who are actually looking to start on income investing, you want to build another stream of income through Singapore REITs, we'll be teaching you how you can do it in this workshop. And this workshop will be held face-to-face. So it's a physical one, it's not over Zoom, right? So what we'll be doing is we'll be covering how you can cherry pick Singapore REITs to invest in. How do you see where or what is a reasonable price point to buy, as well as other key considerations when it comes to execution. Okay, there's one agency chat is disabled for you. Let me see. Okay, let me see. It should be doing okay. If there's still anything wrong, let me know. Okay, it should be okay. Is it okay? Yes, I can see more replies now. Okay, very good. Thank you everyone for your response. And thanks Adrian for letting me know that something is wrong there. Okay, so I'm going to move on to talking about the US markets tonight. All right, our focus for tonight. So the hot topic over the past couple of months, as we all know, is about inflation, right? And the July data came in recently in August, right? The data that came in was 8.5%, okay, 8.5%, which was slightly lower than the expected of 8.7%, right? And the good news is also that this is actually lower than the previous 2 months, okay, the previous 9.1%, and the previous 8.6%. So this data indicates to us that probably inflation might have peaked, or even if it has not come down yet, it is somewhere, really near the peak. Okay, and what contributed for this lower inflation rate for July was the falling energy prices. Okay, whereas on the other hand, actually for food prices, actually it still went up a little. So what happened was that on the day when the inflation data was announced, the S&P 500 has since rebounded, right? It also get up on that day when it was released. So a lot of focus has been on inflation. Everywhere you read the news, anything about the stock markets, it is almost all about inflation. Okay, of course, I know there's also recession and all that. Okay, but almost all is about inflation. But for those of you who have been following me for some time and you know my investing style, you know that when I invest, I don't invest based on the macro news, right? I don't invest based on all this news, or they say the stocks fall and then I get worried. No, I don't really put too much of my attention on the macro news. And one of the biggest reasons why is because the stock market is forward-looking most of the time. In other words, the stock market is usually ahead of the economy. Now, if any of you is jotting down notes or taking screenshots, right, please jot this statement down. The stock market is forward-looking. Because many times investors will think that, hey, the macro data is still so bad right now. The stock market is going to crash even more because the macro data is still so bad. But they forget that the stock market usually moves ahead of the economy. So if you have been following our Telegram channel, we have posted sometime in June and sometime in end June that we actually threw in more bullets, we added more positions in the US stock markets. We didn't buy at that time. We didn't buy only when the inflation data came out to be lower in August. No, we didn't do that only in August. We didn't wait until the inflation data is lower than we start to buy. And the reason why we didn't do that is because the stock market is forward-looking, because we know that the stock market is usually ahead of the economy most of the time. So if you're going to wait until all the macro data is all rosy, I can expect that the stock market has already rebounded and is on its way up, recovering well. And let me show you more of what I mean by the stock market is forward-looking. So if you look at this slide over here, so in June, it was reported, the inflation number that was reported was 8.6%. It was reported for May, so it's one month before. Okay, but in June, we have 8.6% that's reported. And in July, it was reported that we have an inflation rate of 9.1%. So actually in July, we saw a higher inflation rate that was even reported than in June. But did the stock market actually crash lower than in June for July? The answer was no, right? So the answer was no, because the stock market is forward-looking. It has already priced in the future economic data. Likewise, if we focus our attention on the blue color and the gray color area, okay, this one, 8.6, reported in May, and then recently in August, it was reported 8.5%, right? But did we see that the stock market actually performed poorer in August than in May? No, even though the inflation data, 8.5% is higher than the 8.3%. But the stock market did not perform worse off just because the inflation data is higher. Okay. And the reason why is because the stock market moves ahead of the economy. And that's why I don't use macro news as the basis to form my investment about whether I buy or I don't buy, or whether I want to buy now or not. Okay, because if I follow the macro news, most of the time you will usually be late to the game and you will not be able to get in at a good price. Now, financial markets, they are known to price in adverse situations at its worst. But once the bears lose their momentum, that is when the stock market will start to rebound up. This has happened again and again over the past in history. And let me prove it to you. Now, if you look over here, back in 2009, right, during the global financial crisis, the market crashed. It bottomed when? It bottomed in March 2009. But if you take a look at economic data, like for example, unemployment rate, you can see that unemployment rate in March 2009 is a little bit small. This is not even near the peak. Okay, where is the peak? The peak is here, right? This is the peak, but it's not at a peak yet, right? For unemployment, when the market has bottomed in March 2009, unemployment has not even reached its peak. Let me show you more data. In fact, by November 2010, after the market crash has bottomed in March 2009, by the time we reach November 2010, the unemployment rate is still very near the peak at 9.8%, while the stock market has already rebounded up by 80% from the bottom. So you see the stock market is moving faster. It's ahead of the economy. Similarly, during the most recent crash that we faced, COVID crash in 2020, the market bottomed in March 2020. But if you look at unemployment rate, it is far from its peak. Likewise, if you want to compare against, let's say, COVID cases in this case, March 2020, it was just only the beginning of the entire pandemic, right? Whether is it for United States, whether is it for any country, the entire world, it was just only the beginning. But the market had already bottomed and it was on its way up. So from all these historical events, we can learn something. We can learn that we don't necessarily have to wait for the situation or wait for the economy to be drastically better for the stock market to bottom and for the stock market to rebound, because the stock market usually moves ahead of the economy. And on top of that, if we constantly immerse ourselves with all this negative news, all the negative data, it's going to be very difficult to stay joyful in this investing journey. Because every few days, you're going to see a piece of bad news. Like for example, Nancy Pelosi visiting Taiwan, or China starting some military drills around the border of Taiwan, or news on recession, news on slower economic growth, or monkeypox, or very recently you have this virus, the Linia virus, right? Things like this, they are happening, they're always happening. We'll always see negative news on the media. So that's why, while we do read news, while we do read financial news, we do not overwhelm ourselves and really panic when we see the news. Now, recently I was out with a group of friends, and they were telling me that how they don't dare to invest in the stock markets because the economy is very bad right now. And I thought, hey, last year, I recall hearing a similar conversation as well, but from a different friend. So, almost every other year, it is going to be like this. There is always going to be something happening in the economy. So if you focus too much of your attention on all this macro news, what's going to happen is either number one, you don't dare to invest at all. Or number two, if you do start investing, it's going to be a very painful and stressful journey, because every day you see negative news, you see all this inflation data, you see all the news on recession, it's going to freak you out. Right. So back in June, we shared on Telegram that we were buying stocks like Apple, Nike. We also added positions of the QQQ ETF, even though the inflation data that came in was bad, was pretty bad, right? The percentage was pretty bad. Well, while nobody can be sure that this is definitely the 100% sure that this is definitely the bottom, but we don't need the exact bottom in order to profit in the markets. As long as we are able to buy at reasonable buy points, there is near the lows or near the bottom, that will be good enough. You don't need the exact bottom in order to make money in the markets. But if you wait until the news tell you that, hey, the economy is very good now, we have very good economic data, and then you start to buy, right? If you wait until then you start to buy, you wouldn't be able to get in at good prices, because by then the prices would have already gone up much higher. Because why? The stock market always moves ahead of the economy. Some investors might feel that, but I feel safer this way, I feel safer that when I see the economy is better, then I feel safer to buy and invest. Now, I think that this kind of safe, right, is actually a perceived kind of safe. If we truly understand how the stock markets work, or at least how the US stock market works, we know that over the past 20 years, past 30 years, there has been so many crises that seem equally bad as right now, or crises that seem even worse than this. But the US stock market eventually recovers. So that's what have already happened in the stock market. Now, moving forward, where are we heading towards? I'm going to break this down into 3 questions. These 3 top questions that I think most of us would have on our minds right now. The first one is this the end of a bear market? Or are we in a bull market already? Well, there is no formal definition as to how we actually define the start of a new bull run, but the common rule of thumb is to see whether there has been at least 20% increase in prices from the bottom, and it must be for a sustained period of time. That means to say, if today, the U.S. S&P 500 come down, right, and then bottom, and then it shoots up 20%, but for a short period, it starts to come down again. This is not the start of a new bull run, okay, because it must be there for a sustained period of time. Okay, so let's see, where are we right now? Okay, so right now we have rebounded from the most recent bottom in June. We have rebounded by about 18%. Okay, slightly less than 20% from the recent bottom. So if you talk about technically wise, no, we are not in a bull market yet, because it is also not for a sustained period of time as well, right? So we are still in a bear market. Yes, we are still in a bear market. But what is positive that we observed is that we are actually seeing a short-term uptrend right now. That means to say there is actually a change in the short-term trend based on the most recent price movement. Now, previously it was just a downtrend, but recently we have started to see some short-term uptrend. How do you tell if there is a short-term uptrend? Okay, let me share with you. So how do you tell if there's a short-term uptrend? Now, there are a number of ways that we can look at the chart and identify if there is an uptrend. Different investors will use different indicators. For me, my own personal preference, I either would prefer to use number 1, moving averages, or number 2, to see whether the prices are making consecutive higher highs and higher lows. So for today, we are going to just focus on this second one, whether the prices are making consecutive higher highs and higher lows. And this is also the method that I have shared before in one of the previous Zoom webinars before. Now, bear with me, especially for those of you who have attended my previous Zoom webinars before. Okay, so I will share with you how you can analyze trends. How do you identify if it's in an uptrend or if it's in a downtrend? Now, on the left, you see an uptrend, and on the right, you see a downtrend, correct? On first glance, I think it's a no-brainer that you can tell that on the left, it is an uptrend, and on the right, it's a downtrend. Anyone can tell that. But what is one thing that many people miss out on? The one thing that many people miss out on is the price movements that are within the trend. That means to say, for example, in this uptrend, what we see is not just a straight line up. We don't see a straight line up. All we see is we see the prices going up, and then it will dip a little, it goes up, dip a little, goes up, dip a little, goes up, dip a little. So it's all this price movement that we want to look at when we are identifying trends, whether it is an uptrend, downtrend, or is it just moving sideways. Okay, let me elaborate further. Now, so you can see over here on this slide, I've already drawn out all these arrows in black. You can see that in an uptrend, prices will first move up first, and then it will retrace a little bit, and then it will rally up again, and retrace, rally, retrace, rally, retrace, rally, retrace, rally, and retrace. And then this whole pattern will continue, right? So the rally and the retracement are what we want to focus our attention on. So in an uptrend, it is one whereby the prices are making higher highs and higher lows. What do I mean by higher high and higher low? Can you see that when the price rally up until here, this is a high that it makes, and then when it comes down here, this is a low, and then this is a high, this is a low, this is a high, this is a low. So you can see that the second high is higher than the first high. Likewise, the second low is higher than the first low. The third high is higher than the second high, and the third low is also higher than the second low, and the pattern continues. So this is what I mean by consecutively making higher highs and higher lows. And when you see that there are at least 3 consecutive such higher highs and higher lows, it means to say that this is an uptrend, right? It's actually very easy to remember. Just imagine yourself, let's say today you're running a 10-kilometer race. During a 10-kilometer race, unless you are a very trained runner, it's going to be very difficult to run at the same speed throughout that 10K, right? When you have energy at the start, most likely you feel like, okay, I want to chong more first, I want to run faster first. But at some point in time, you run out of energy. And then you will think, okay, I run out of energy, I need to catch my breath, so I slow down a bit. Then after that, once you are good, you have more energy, you want to run faster again. Then after that, you got no breath again, so you slow down a bit. Then you run faster again, and then slow down a bit. And then this cycle repeats. So if you look at stock charts, it's something like this. Eventually, you'll finish your running the entire 10 km. But same for stock charts, what you see is that when there are more people buying, the prices are going to rally up. And then we start to, at some point in time, we'll start to lose some, we'll run out of steam, we'll run out of buyers. So it comes out a little bit, but it's just a little bit, right? And then we have more buyers again, it goes up, and then run out of steam again, come down, and then go up, come down. So this is how an uptrend looks like. A lot of people, they'll just think, okay, uptrend, just go up long. But it is more than just a straight line going up, okay? Okay, so if you guys are lost at any point in time, you can also just let me know and I'll just repeat it again, okay? But I hope that by saying it, explaining it this way, it makes it easier for you to understand. So when we talk about identifying a more sustainable uptrend, we want to see the prices making higher highs and higher lows for at least 3 consecutive times, because it will tell us that the momentum is there. Of course, the more the better, but if you have more, it means that the uptrend is stronger. But at least 3 consecutive times, right, to say that there is an uptrend. So let's go to S&P 500. Can you see what is happening over here? Okay, so what is happening is that we are actually seeing a very short term. In the short term, there is a short term uptrend. Longer term wise, it is still a downtrend. But at least in the very short term wise, this is something that is positive that we see that we haven't seen since the start of the year. Okay, so if you look over here, you can see I'm going to draw. So from this bottom, the prices went up and then it came down, right? It went up, came down, and then it went up, came down. So you can see that the highs are actually higher and the lows are also higher. So right now, in terms of very short-term wise, there is this change in trend into uptrend, and this is the positive sign that we see. But of course, this is, we are still in a bear market. Technically, we are not out of a bear market yet, but at least we see that the things are progressing better. And this is also barring any black swan event that may still suddenly happen. Anything could happen in the world, right? But the problem is that many investors, they tend to feel that they have to wait until a bull market is confirmed, that the start of a new bull run is confirmed before they dare to buy again, before they dare to invest in the stock markets again. But like I have mentioned earlier, if you want to wait until a bull market is confirmed, prices will have gone up by a lot. And that would also mean to say you actually miss out on the chance to buy the same thing at better prices, right? Currently at great opportunities. Well, and if you invest during a crisis, what history tells us is that over the last 20 years, recoveries have followed sharp declines and long-term investors benefited. Now, I may sound like a broken record because a lot of times I keep reiterating this, whether on Telegram, on Zoom, on YouTube, on our social media platforms, and so on. But why I keep saying this is because we shouldn't let a crisis go to waste, because that is the best time where we can buy good stocks, or even if you're talking about investing in S&P 500, buying the SPY ETF, that is the time where you can buy them at very good prices, right? And such crises, they don't always come, every other few months. You don't have a 20% decline, a 30% decline that comes about every few months or every half a year, right? So if you look over here, based on this data, we see that actually there is very good return, right? When we have a drawdown, the purple color one, you see that within the next 1 year, the cumulative return for S&P 500 is a double digit, 34%, 69%, 75%. And the 2-year cumulative return is also a double digit. Same for NASDAQ as well. Okay, so this is the reason why, because data, statistics have already shown that you would benefit over the long term if you take advantage of crisis. Now, I'm going to move on to the second big question that I mentioned earlier. Okay, because, so some of you might be thinking, hey, Hazel, so since you say that we are not yet in a bull market, right? We are still in a bear market, but are we at least, heading towards a bull market? Or is this current rally that we are seeing in the S&P 500, is it just another bear market rally? Is it just a dead cat bounce? Because if you read the news, a lot of the news articles say that this is just another bear market rally. These are the signs that the bear market rally in stocks won't last long, according to Citigroup. This is another textbook bear market rally that will fail. It's a dead cat bounce. Investors are putting their money back into cash because of recession. So is the U.S. stock market going to tank again? Will it crash again? Or we are really heading towards a new bull run? Now, for this question, of course, I can't give you a 100% definite answer because nobody can predict, right? But what I can do is I can share with you my opinion, my guess, but this is just my guess, okay? And it's not a financial advice. But my guess is that I don't think this is a dead cat bounce. I don't think this is just another bear market rally. And my guess is that, and I'm hoping that the market has bottomed in June, okay? So what's the reason? First reason is, as I mentioned earlier, the change in the short-term trend to uptrend. That is something positive that we have seen at least since the start of this year, right? Although the longer-term trend is still a downtrend, but at least we see some positive development that the very short-term wise, the trend is changing into an uptrend. So this is something that's positive that we haven't seen in the markets since the start of the year. Reason 2 is the falling oil prices. Now, I don't really base it on inflation data because those economic data, they're lagging. But if you look at, say, crude oil futures price chart over here, we can see that the prices are actually on a downtrend here. Okay, if you apply what I teach you just now, right, you can see that we have lower highs, lower lows, okay? Lower highs and lower lows. Okay, in fact, I have drawn it out here. Let me clear. Okay, you can see that we have lower highs. The high is lower, the low is also lower. So we are actually coming down on a short-term downtrend for crude oil prices. So from here, where can crude oil prices go? there are only three ways, right? Either from here, it shoots up, or it moves sideways, that means it consolidates, or it comes down, right? So of course, under situation number, let me name this. Under situation number 2 and 3, that means either prices move sideways or come down, it will be good for the S&P 500. It will generally be bullish for the S&P 500. But if the oil prices suddenly shoot up drastically again, then yes, S&P 500 can still plunge back down. So crude oil prices is one area that I would also continue to look out for, to monitor as well, to see how it's going to change. Now, of course, because it's coming down on a downtrend, right? Even in a downtrend, like we have learned, we have a rally and we have a retracement, right? So it will still go up one, but it's how much it goes up, whether it's going to break up into an uptrend again, or is it just a continuation of this downtrend. So that is something that I'll continue to look at the crude oil prices as a way for me to monitor the situation as well. Then another additional indicator that I will want to look out for is the VIX index. Now, some of you, okay, if you've seen my YouTube video before, I think you should know what is a VIX index. Okay, what I want to look out for is whether the VIX index can stay below 20, the level of 20, for a sustained period of time. That means it's not just for a while, it is really for a sustained period of time. Because if it does, then the S&P 500 will continue to rally. Okay, so for the sake of those who don't know what's a VIX index, the VIX index, it measures the 30-day expected volatility of the US stock market. And how they come up with this index is that they just use all the call options and the put option prices of the S&P 500. Now, the detailed mechanics you don't really have to know. But what you have to know is that in layman's terms, what it means is this index is used, or it's seen as a way to gauge the level of fear among the overall market participants. So when markets are, okay, let me toggle to the trading view and I'll show you what I mean over here. Okay, give me a moment, I'll toggle to the trading view. Okay. Okay, can you guys see the trading view? Okay, if you cannot see, let me know in the chat box, okay? Now I will continue. Okay, so what we see over here is that, give me a moment. Okay, now if you look at the past performances, okay, let me open this up. Okay, so I have put on top here, you can see this is the VIX index, and at the bottom is the S&P 500, okay, SPX. And we can see that generally when the VIX index falls below this level 20, which I've drawn using a blue color line, for a sustained period in time, the S&P 500 actually tends to do well. But let me show it to you. If you look over here, this period, you can see that the S&P 500 actually went up. It's upward sloping, right? This period over here as well. Okay, let me adjust it a little. When it's below 20 for a sustained period of time, it's not just at one point and then go up already. It's for a sustained period of time. You can see that generally, the S&P 500 also goes up. So you can check out the data yourself as well. This is on TradingView. Okay, TradingView is free of charge, right? So I think you just have to create an account so that the things will stay there. So you can see that generally, when the VIX index goes below 20 for a sustained period of time, the stock market goes up. Can you see this uptrend for S&P 500? Okay, so another indicator that I want to look at is whether or not this VIX index can, right now, no, not yet, right? Right now, only touch the 20 and then it goes up already. What I want to see is whether it can actually come down like this. Let me draw. Whether it can come down and stay below 20. Because if it does, it's going to tell me that S&P 500 would generally be doing well. It will be going up already. Okay, so this is one thing you can also look out for. Let me switch back to. Okay, let me. Okay. Okay, so we're back on the slides. Okay, then some of you might ask, what about a recession? Okay, right now we are in what we call a technical recession. That means by definition, we are supposed to be in a recession by definition when the GDP contracts for 2 consecutive quarters. So since the US GDP has already contracted for 2 consecutive quarters, by definition, this is like what we call a technical recession. But it is also rather ambiguous because there are many mixed signals. So right now, it's more of like a recession by definition, but not really yet in substance. For example, there could be many arguments whether there might be a deepening of recession, we're going to hit into an even deeper recession, or whether we're going to go into a real recession. And let me present to you the arguments for the side on no first. So we know that GDP contracted in Q1 and Q2 this year. But what we also know is that in Q1 2022, the GDP contraction is kind of skewed. The data is kind of skewed. Why? Because of the trade deficit that was caused by the COVID supply chain disruptions. Now, we all know that GDP, how we calculate GDP is to take consumption plus investment plus the government spending plus the export minus imports. Okay, we don't need, this is the formula to compute GDP, but we don't need to go into the details. So the performance for Q1 for all these other factors were actually okay. Okay, they were doing okay. But what's the problem is this one? Because for this part, it went into a trade deficit. That means to say the imports was bigger, was larger than the exports. And how come the imports were larger than export? There's also a reason for this. It was because of the supply chain disruptions from COVID. What happened was that there was delay in imports. So all the major shipping ports, they were trying to catch up with the shipments, with the delays. And these shipments only arrived in Q1 2022, when some of them should have been for 2021, the year before. So the higher level of imports is causing this trade deficit, which then lowers the GDP and causes the Q1 2022 GDP to contract. So this could be an argument for that we are not really in a recession in substance. Okay, then another argument would be that we are still having a tight labor market. But of course, like I mentioned before, all the data like unemployment, labor market data, all these are lagging indicator. But at the moment, at least it does not seem to be worsening yet, right? Then on the other side of the argument, this one, we have it that some people say, okay, if the Fed continues to raise the rate by too much, it is going to slow down the economy and it's going to deepen the recession, right? So on the other side, yes, we have this argument as well. So I would say that there are actually many mixed signals, and I've only just named a few of them. But more importantly, it is what I'm more focused on is really not all this. What I'm more focused on whether there'll be a greater recession, whether there'll be a real recession, or whether the S&P 500 will crash again, is earnings growth. Because ultimately, what drives a recession is not things like high unemployment, right? High unemployment is an effect of a recession when the businesses are not doing well, right? What drives a recession is whether the businesses are making money, whether they're still making profits. So what I want to look at more importantly is whether the earnings per share is still growing or is it actually contracting, to tell me if businesses are still making money in general. So historically, if you look over at this chart over here, historically, when the EPS contracts, that means when we have all the bars that are below the x-axis, the S&P 500 tends to perform poorly. And let me show it to you. Okay, so we have this one over here. This was during the dot-com crash from 2000 to 2002. And you can see that we came down by 40% for the S&P 500 when the earnings per share was contracting. It was below this x-axis. That means it's contracting. It's the negative percentage. Same for 2007 to 2009, the global financial crisis. S&P 500 was also down by more than 50%, right? And we also saw this sign that the EPS was actually contracting. The businesses were not doing that well. 2020, same thing as well, right? This time around, the S&P crashed by more than 30%. So where are we right now then? Okay, the second full quarter data, I don't have it yet. Okay, I only have until Q1. But at least based on what we see right now and based on the recent earnings season, yes, the growth is slowing, but it is not slowing at an alarming rate. Okay, and most importantly, we don't see the EPS contracting yet, right? So it is slowing, but it's not at an alarming rate. The recent earnings for Q2 is not good, but it's not that bad as well, right? Yes, I get that every other day you will see news talking about recession, you will see news talking about the markets crashing, or people around you, your friends who are also investing or haven't invested yet, they may also seem very pessimistic about the economy, about the markets, because I hear them from my peers as well. So I understand that all this can really freak people out. But if we understand and if we can look at the grand scheme of things, you will know that eventually the US stock market will recover, even if really a deeper recession hits. You know that eventually the US stock market will recover. And in fact, when we invest when the consumer sentiment is low, it has been shown that we tend to enjoy double-digit returns in the S&P 500, right? If you look over here at this chart, might be a little bit small. If you look at the 8 sentiment troughs over here, you can see that for the 8 sentiment troughs, the average subsequent 12-month return for S&P 500 is a double-digit, 24.9%. Whereas if you invest when everyone is feeling very, very optimistic, at the peak, at the sentiment's peak, that means everyone feeling very happy on the markets. The average subsequent 12-month return for S&P 500 is only a 4.1%. That means to say we should actually be feeling happy, right, when the general sentiments are still pessimistic. Because that's our chance to profit in the markets, isn't it? So if you can learn to view crisis in a more positive light, and you use them to our advantage, that is how we can continue to stay joyful in the stock markets, in investing. Okay, let me clear my drawing first. So I talked about the first 2 questions already. I'm on to my 3rd question. Okay, so I talked about whether we are still in a bear market, and I shared my opinion on whether I think this is just a dead cat bounce or just a bear market rally. So now the 3rd question that you guys will be asking is, so since Hazel, you say that we should tap on this crisis, right? So should we buy into, let's say, for example, S&P 500 now? If let's say I want to invest in the SPY ETF, should I buy now? Okay, let's go to the charts. Because stock charts will tell me more stuff than what is the current price. A lot of people think that stock charts are not important. They only tell me what is the current price or what is the price the day before or the week before. But actually, it tells us a lot more things. If we know how to analyze the charts, right, it tells us the sentiments of the overall market participants. And that is where we can identify probable turning points for the stock prices. Okay, so let's go back to the S&P 500. Now, when I was preparing for this sharing, right, when I was preparing the slides over the weekends, this was the chart that I took at that time. So remember just now earlier on, I teach you guys that in an uptrend, you will have a rally and then retracement, rally, retracement, rally, retracement, right? So what you can see over here, as at last week, last Friday, right? We have a rally, retracement, rally, retracement, rally. So what's going to come next? Retracement. And did it come? Yes, it did. So starting this week, what we see over here is that we have the retracement right now already. Okay, it's already starting since Monday, before I could even hold this webinar to share with you guys. Okay, so this is not a coincidence. Some of you might think, oh, it's just a coincidence. This is technical analysis. It is not I anyhow say one. It's also not a coincidence. It is something that has been proven that it will always happen again and again over the long term. So it is not just like pure magic or anything, okay? Day charts. Yes, day chart. Okay, you can see over here 1 day. So this is a day chart. I think you mean day chart, right? Okay. Okay, so another indicator I just want to share with you guys that also tell us that this retracement was going to happen very soon. I wanted to share this with you, but it happened already. Was that we have this percentage of S&P 500 stock above 50-day moving average. Now, for this chart, okay, when it might look very scary at first glance, let me explain to you. Whenever this percentage of S&P 500 stocks above there are 15 moving averages. It hits this 90 level. Can you see this 90? Whenever it hits, I also draw this blue color straight line over here. Whenever it hits this 90, right, there is a high chance that S&P 500 will start to come down already. It will start to retrace down. Okay, so this is another indicator which shows that this retracement is actually bound to happen very soon. Even if it doesn't happen from Monday, it is also going to happen very soon. Now, but this doesn't mean to say that the market is going to crash. What I'm saying is that a retracement is going to happen, but I'm not saying that it's going to crash, okay? From this indicator, you cannot really tell if it's really going to crash or what. Because, for example, if you look at 2020, sorry, hold on a while. Okay, if you look at 2020, this is 2020, right? During sometime in June, here, this is June. It hit 90, right? And it came down. I don't have the S&P 500 chart over here, but if you look at it, yes, there is a retracement as well, but it wasn't a crash. So it doesn't mean that when this comes down, the stock market, the S&P 500 is going to crash. No, this indicator doesn't tell us this. Okay, it just tells us that, it just let us know that we are going to be having a retracement soon. So this is one indicator that you can look at. For those of you who want to learn more about this, right, how to get this, you either do a Google search. There are a number of websites that will give you this chart. Or you can go to TradingView again and you use this sticker. You just type in S5SI and you will get this thing. That might look a bit scary on first glance, but it's really not that scary. Okay. Now, so I know that it's going to retrace, but the problem is, how do I know how much the prices will retrace by? Is it possible to have, roughly a plan as to when do I want to buy? Right? How do I know which price level do I buy? Should I buy now? Should I buy yesterday? Should I buy tomorrow? So this is where technical analysis comes in. And this is where we try to identify certain probable levels. So one probable level where prices may retrace to before they rally up is this blue line that I've drawn, which is at somewhere about $415. Now, why is this a probable level? Because this is a level where prices have previously hovered around for some time. If you look at point A, okay, prices have actually hovered around this level for some time before it went up. If you look at point B, same thing, it hovered for some time before it came down. If you look at point C, so for A and B, this level is acting as a support. But for point C, this level is acting as a resistance. Okay, whereby you see that prices hit here and then they start to hover around here but cannot break through, and then it starts to come down again. So this is actually a level whereby there is a very high tendency where the historical prices hover around that area for some time. Okay, so this is what we will call a probable level at 415. Okay, so this is one probable level, but now this is based on probabilities. That means to say, I'm not telling you 100% confirm plus short. Price hit here, confirm will rebound back up again. I'm not telling you 100%. There's no 100% for the stock markets. There's no 100% in looking at charts as well. But at least it tells us where the markets might be going. At least we are prepared what might happen. Okay, so stock prices tend to they tend to revisit previous high probability levels, and that is why we look at technical analysis, and that is also why technical analysis works most of the time. So right now you can also see the most recent price. We have the most recent 3 candles over here, right? It might be a bit small on the screen, but you can see that they also hover around this $415 level as well, right? So this is one of the probable level. Okay, but usually I don't just identify one, right? I want to have a kind of like a plan or a backup plan, or in case the stock markets doesn't rebound back, it continues to come down even more, then should I add again if the market comes down even more? So this is where I will identify my next probable level. Okay, so previously I've talked about Fibonacci retracement tool before. Now I'm not going to explain the mechanics today because I have explained before in previous Zoom, and I think I'm actually running out of time. I wanted to keep this within 45 to 1 hour, but I'm not at Singapore markets yet. Okay, so if you want to understand the mechanics, you can check out my replay video that I published on YouTube. Okay, but I'm just going to show you how to use this Fibonacci tool to identify our second probable level. Okay, give me a moment. I'm going to switch screen to the trading view. Okay. Okay, S&P 500. So we are on TradingView right now. Okay, I've already previously drawn that. That's why I could get the screenshot for the slide. But how we can actually use the Fibonacci tool is this. You can actually click over here. If you follow my cursor, click here and then you click on the Fibonacci retracement. Then what you do is, okay, I'm going to draw over this. Or maybe. So what you do is you will first click on the most bottom, the bottom, the last point over here. And then you click one time, you don't click, you don't hold, and you click the second time that coincides with the peak. And that's how you have the Fibonacci level. Okay, I'm going to erase this away. So this is how you draw. Okay, now, so I'm not going to explain the mechanics because I'm running out of time right now. But what we can see for this is that, okay, what are all this 0.236, 0.382, 0.5, 0.618, and so on? These are what we call the Fibonacci levels. Okay, so if you see this Fibonacci retracement, after I draw, can you see that this 415 level, this blue line, actually coincides with one of the Fibonacci number, which is 0.236. Yes, so that means to say that it makes this level an even more probable level. That means the probability of prices retracing to this level is even higher. Now, so if in the event prices actually continue to come down, what is the next level that I want to look at? That would be the next one at 0.382, right? And ideally, if it comes down to here, and then if we bounce back up, we will still be, the short-term uptrend is still intact. So the next level that I want to look at, that I might want to ideally add more, add a second tranche of my shares, if I were to invest in this SPY ETF today, is probably at the 0.382 level. So that's how I will use the tool to identify, okay, the probable levels and identify when, at what price level I want to enter. Because all these tools, it has been shown that over time, in terms of probabilities, it works, okay? Prices tend to respect all these respective levels that are indicated out based on the tools, okay? So this is just one of the tools that I use. Of course, I have other tools as well, but just to share every one of it that we use, okay? And this is also what we do when we try to see when do we want to buy. That's why we don't just base our entries, base it on macro news. No, we don't actually time our entries based on macro news. That's not how we do it. We really look at the stock chart because stock prices tend to respect the technical analysis, the previous prices. Okay, so if you guys got anything that you don't understand, anything that I talk too fast, you can let me know as well. If not, I will move on to talking about Singapore markets already. Okay, let me change screen. Okay. Okay. So this is how I would actually look at the charts. Now moving on to the Singapore markets. Okay, I know I'm a bit behind time, but we have still a bit more on Singapore markets. So moving on to Singapore markets, you can see that actually the STI performance it's not bad, right, compared to the S&P 500 for STI. But at the same time, you can also say that things are not that exciting for the STI index. All right. So during our March update that we did on Zoom sometime in end of March, right? At that time we were, I mentioned that it wasn't a good time to invest in the STI index, right? And for those of you who were there at the time, I hope you remember the reason why, because I shared that there is a very strong resistance zone that spanned the last 15 years. Okay, if you look at this green color zone, green color rectangle, this is a very strong resistance zone that spanned the last 15 years. What it means is that whenever prices hit this region, it tends to go back down. It tends to go back down. You see, it tends to go back down. So at that time when I did the sharing in March this year, we were also somewhere near here, right? And I said that that's really not a good time to enter the STI at that time, even if you were thinking of buying, right? And indeed, what happened was that the prices actually came down. Okay, it hit the resistance. That was sometime in March. It hit the resistance, came down. Okay, right now we are somewhere here. So this is actually a resistance zone that has spanned over the last 15 years. So you can tell that it's actually a very strong one. Now, when I invest, I always go with the trend. I never go against the trend, right? If I know that such thing might probably happen, although it's not 100%, but I don't go and bet against it because I always move with the trend in the markets, right? The trend, just like what some of us always say, the trend is your friend. And I act accordingly to the probabilities based on the price movements. So for example, if you look at one of the very popular stock in Singapore, which is DBS, I think it's one of the most popular stock for Singaporean investors. There were many people who actually asked me, why was I not adding more positions of DBS last year or even this year? When the prices were actually going up last year or the start of this year. Now, the reason why I wasn't adding more position was not because the stock was not good. No, right? DBS is a good stock. Yes, I would love to own it as well. But it is more of whether whether I would be buying at great prices if I were to buy last year or even this year. Because you see, a good investment is not just only about buying the good stock. It's also about paying a good price for the good stock. Let me change over to the trading view and I'll show you what I mean by this. Okay. Okay, we're back on the trading view. Okay, let me put this aside first. Okay, so if we toggle to the weekly charts, if you look over here, this is W, right? So this is the weekly charts right now. So if you toggle to the weekly charts, you can see that actually over the long term, if you follow my cursor, right? DBS prices actually go through very huge cycles. Yes, no doubt there is an uptrend, but within the uptrend, there are many cyclical movements, right? Can you see? The prices actually go through a very huge cycle, okay? So let me show you this. Okay, so I've already pre-drawn. So yes, there is a uptrend over the long term. This is the longer term uptrend, right? How we draw uptrend is we can actually identify all the bottoms and then we connect it. As much as possible, you connect as many bottom as possible to form the trend line. So this is the uptrend, but within the uptrend, there is a lot of cyclical movements. So you see, it goes through all the cyclical movements. That's why there are a lot of support and resistance that I have drawn using the blue color line. Okay, a lot of support and resistance. And that also means to say that if I want to buy DBS, right, there is a chance to buy at great prices, right? Because the prices tend to move through huge cycles in the short term. Although over the very long term is an uptrend, but it takes very long to have that uptrend. In the middle, you can go through very huge cyclical movements. The price change, the change in the price movement can be very big, right? So that was why I didn't add more positions on DBS last year and also this year. So right now, at this point in time, would I want to buy or not? That would be the question that you would want to ask me, right? At this point in time, I will still say no, right? And let me share with you the reason. Now, first reason is if you look at this red color trend line that we draw. Okay, so this red color trend line is you draw by connecting all the bottoms together. You connect as many of them as possible, and you have an upward sloping trend line. Now, what we do is that we will extend this trend line a little bit, and you can see that actually right now, the current prices is still very far off from the trend line. Right, so it is very much overextended yet, right? So so in terms of this, I would think that in terms of the risk to reward, it is not working in my favor. It's not that good at the current price, right? The downside risk is actually greater than the upside reward. That means the chance of it coming down is even greater than the chance of it going up. Now, the second reason is if I were to analyze all this cyclical movement using support and resistance, right? You can see over here. Let me clear my drawings first. Okay, you can see over here. I just show everything. Okay, so what you can see over here is that this is actually a resistance line. Okay, the one that I'm hovering at is a resistance line from 2017 to 2020. And this line is a support line for period 2017 to 2020. So prices actually hit this resistance, come down, and then hit this support, went up again, and that it actually exceeded this resistance in 2021 and 2022, right? And right now it came down again. So is this $30 level? Okay, this is $30. Could this $30 level be a resistance turn support, or could this just be a false breakout? Now, I don't have to answer, but based on what we see, prices for DBS tends to move in a very highly cyclical manner, right? So my guess is that it will still come back down to this range between the $20 to $30 price range in time to come. I don't know when exactly, but yes, it would come. Because stock prices, they tend to revisit, they tend to respect previous strong probable levels at all these blue color levels that I've drawn. How long it will take, I can't predict that, but these are the two reasons why I don't add more positions of DBS last year and this year. Because based on the chart, the risk to reward is not working in my favor if I buy now. That's why I'm not doing that. And instead of putting my money in a stock where the risk to reward is not that favorable, I'd rather be investing that money into somewhere else, other stocks. For example, if you look at right now, there are many US stocks at very good prices, reasonable prices. So that's the reason why. And at the end of the day, it's also because that we all have limited capital to work with, right? We don't have a huge sum of money that we can use it. Okay? We work hard, we have our hard-earned salary, part of it we save it up and we invest. So how are you going to make use of this limited capital, right? So that is why I'm more selective when it comes to the stock that I buy and also the price that I buy. So the important thing is really to set up a list of good stocks that you're willing to buy, and then look out for opportunities for those that are trading at great prices that you can invest your money in. Okay, Adrian says 2023 to 2025. Maybe, right? I don't know. I can't predict. At the moment, with the data that I have, I can't predict, but it's probable that it would come down, okay? So it's just a matter of where you want to put your money in. Whether you want to put it in this or you want to find another stock whereby the risk to reward is working better in your favor. Okay? Okay, now let me switch back to the slides. Okay. Okay, so moving on to Singapore REITs, the overall performance of the IH REIT index versus the STI, our Straits Times index, has been poorer. Okay, you can see over here the blue color is the REIT index, orange color is the STI index. You can see that since this is year-to-date performance, it is poorer as compared to STI, right? Against this current high interest rate environment, right? But if inflation really peaks, right, with better inflation data, possibly we might start to see better performances for the Singapore REITs as well, right? It also depends on how aggressive the rate hikes might be. Note that the Fed will still continue to raise rates, okay? It will still continue to raise the rates because the inflation rate is still high. Okay, even if inflation peak, it still has to continue to raise the rate because the inflation is still high. But it's just a matter of how aggressive the Fed might be. Okay, so with a better inflation data, it might help. We might start to see better performance for Singapore REITs in general moving forward. But again, if it is a good REIT, right, if it's a fundamentally strong REIT, then you shouldn't be worrying about all these short-term macro headwinds. In fact, it is a good chance for you to buy them at good prices currently. Now, this is a screenshot that I've taken, which compares the performance of the Singapore REITs by sectors. So you can see that the performance is actually very different, vastly different for different REIT sector. Even within one sector itself, we can see very different performance, right? If you look at a year-to-date column, within one sector itself, we can have some REITs doing well, some REITs not doing well. But actually that to us is kind of a good sign, because it tells us that there are probably opportunities for certain REITs, right? Certain stock counters that we can buy them at great prices. For example, one of it is Mapletree Logistics Trust. Now, in the recent earnings reported, it continues to report very robust financial performance. We saw increase in revenue, NPI, DPU. It is also a REIT whereby it's very diversified across various countries, and you can see that it has very stable and high occupancy rates, not just for this quarter, but in fact over the years. Right. And for those of you who are very concerned about high interest rate environment, what is positive that we see here is that MLT has about 80% of its debt that are hedged or drawn in fixed rates. So that is a good thing in the current setting as well. Okay, let me look at the chart for this REIT itself. Okay, let me go to this. Okay, so this is the last chart that we'll look at for tonight, which is the chart for Mapletree Logistics Trust. Okay, so now how is the price chart right now? Okay, is it a good entry point to buy Mapletree Logistics Trust based on technical analysis? Okay, so what we've seen last year was that, okay, if I change it to a daily view, okay, what we see previously was that, after that COVID crash, right, it went up by a lot. And then right now, then it came down, but it was still okay. And then right now it's coming down again. Okay, so is this a good point to buy now? Okay, let's see what we can analyze, okay? Okay, so you can see for this REIT itself, over the very long term, it is moving up, right? The prices are actually going up. You have an uptrend, okay? Whereby if you connect the lows as much as possible, right, you have something like this. Okay, of course, there are other lows that I couldn't connect as well, okay? But if you look at this T1, you can see that over a long term, the prices are moving up, okay? Okay, now, but if I follow the same way, right, if I want to only invest when prices hit this trend line, this T1. Okay, let me call it T1. Okay, where is it? Okay, this one. Okay, I call this T1, okay, for easier reference. If I want to wait until prices come down and hit this T1, is it going to take very long? Probably, right? Why? Because if you look at how many times over the last 15 years, how many times has prices hit and tested this T1 uptrend? One time over here. Okay, let me unhide all this. One time over here, 2 times, 3 times, 4 times. So it seems that over the last 15 years, it's not that probable, right? In terms of probability, it's not that high. Is it I must wait for another 5 years, 10 years that I can invest in this? So if you want to wait until prices come out T1, then you buy, it might take really very long, right? So instead of looking at T1, why not let's try and find another line? Okay, so another one that I have shown is this T2, okay, which tries to connect the other lows that were formed, right? And where prices actually hover around for some time. So if you look at T2 versus T1, you can see that for T2, prices actually hit this T2 more than the T1 over the past 15 years. You have number 1 over here, then this region as well, this region as well, this region. Okay, in fact, this is a resistance here. Then this region, this region, this region. Right, number 7 is the most recent one. Okay, that means recently it actually hit this T2. So it seems like this T2 is a line that is a line that is more probable, whereby if I want to enter and buy this stock, if I look at this T2, it will give me a chance, and it will also allow me to enter at a good price. Now, okay, so what's next? So if you look at what we are seeing right now, right, prices, okay, I'll zoom in here a bit more. So you see, this is Jan 24, somewhere January this year, it actually tested already. And it came down below, it went up, And right now it is still testing this area. So actually for me, okay, this is not a stock pick, this is also not an advice, okay. For me, I would think that currently I might want to buy, like if I were intending to buy, okay. I'm just sharing with you what I do, this is not a stock pick, okay. And if we try and apply Fibonacci, which we learned just now, okay, I've pre-drawn already because I don't have time already. If we try and apply Fibonacci, we can see that actually when I was preparing the slide, it was a very nice view. Let me see this. Okay, so if I apply Fibonacci and I actually connect the peak to the bottom, right, you can see that previously when I was preparing the slide last week, prices actually were hitting this area, which is the 0.382. Remember, 0.382 is one of the Fibonacci levels. So actually prices hit here, there was some form of resistance, it came back down. And right now it's also testing this T2 black color trend line, plus it's also somewhere near the 0.236 Fibonacci level. So for me, I would think that, for me currently, I would think that it's actually a good entry point for myself. This is not a stock tip. I must repeat a lot of times. Okay, so this is how I will actually look at the stock chart. Okay, because remember just now earlier on I teach you guys about uptrend, right? Same for downtrend. Downtrend, when it goes down, right? When it goes down, it will rally up a little, then it will retrace more, come out a bit, retrace more, come out a bit, retrace more, right? So when it was I mean, just what we were seeing last week is we were actually at the rallying up part, and this week we actually saw the retracement. Okay. Okay, let me change back my view to the slides. Okay. Okay. Right, so for those of you who are interested to learn more about how you can build your own portfolio of Singapore REITs to generate passive income, we have an upcoming workshop that is coming on 18th September, which is a Sunday at 1:30 p.m. And it is a face-to-face workshop. Okay, the venue, we will send it out to you, we'll email you again nearer the date. Okay, so in this workshop, the content that we're going to cover is how you can cherry pick the Singapore REITs to invest. Okay, you will learn how REITs work, how to cherry pick Singapore REITs to invest, how do you find or identify reasonable price points, okay, by looking at the charts, as well as other key considerations when it comes to the actual trade execution, right? So it will be a face-to-face workshop, a physical workshop that is held on a Sunday afternoon. So if you're keen to learn how to generate passive income through income investing through Singapore REITs, you can scan this QR code on the screen over here, and it will bring you to the page to enroll, and we have more details on that. Right. If you have friends who are also interested to learn more on how to generate passive income through Singapore REITs, you can share this workshop with them and join us together on 18th September. Okay. Please take note that the venue will be finalized nearer the workshop date, so it will be blasted out to you via email. That means to say when you key in the email, when you sign up, right, it must be a valid email address. Not later, I cannot reach out to you. Okay. So keep a lookout for the email as well in case it reaches your spam box. Okay. So with that, thank you guys for coming and joining me tonight for this Zoom sharing session. I wanted to keep it within an hour, but I have exceeded. So that's what I wanted to cover for tonight's market update for US and Singapore, right? So if you find our short Zoom sharing useful, join us in our future sharing because we are going to be holding this regularly. Almost every month, right? And you can also invite your friends along to join us on Zoom as well, right? If you have any questions, I'll still be staying around. Or if you feel shy to ask me here, you can also always drop us an email at hello@thejoyfulinvestors.com, or through the website, there is a contact form as well, right? So thank you guys for taking the time to come for this Zoom webinar, and I hope to see you guys again in future sessions. Okay? Stay invested joyfully in the stock markets.